Hello, everybody. This is Alan Ellman, the Blue Collar Investor. Over the years, I have shared with you hundreds and hundreds of trades taken from my portfolios or from those of our members. We've broken them down. We've looked at ways we could have improved on these trades, things we liked that we did, and we want to continue to do. And those trades have been shared with you in my books, in my videos, in my webinars. But more recently, members have been asking if I could do the same thing, but with an entire portfolio. How do we structure that portfolio? What are the thought processes behind our decisions? So what I decided to do for the January 2022 contracts is to actually establish a portfolio in one of my brokerage accounts dedicated specifically for this video. And what I decided to do was to fund this portfolio with $100,000. So we're starting off with a nice even number. And we're going to use it for covered call writing. And we're going to use the select sector spiders so that we have diversification and everything nice and simple for this video for structuring, managing, and getting final calculations and results for this entire portfolio. So it will be a 1-month covered call writing portfolio from start to finish. Now, one of the things that we know is that market conditions will dictate the success or lack thereof of our trades. Now, for the beginning of the trading year 2022, there were a lot of concerns that caused the market to decline at the beginning of the calendar year 2022. There were inflation worries, interest rate worries, still COVID worries, and a lot of global political events that were concerning us. So the 2022 January contracts were not a happy time for investors. Nonetheless, we want to show you how this portfolio was managed and the final results reflecting some of the things that option selling can do for us. So let's start off by defining what are the select sector spiders. Now, these are exchange traded funds that divide the S&P 500 into 11 different categories, sector index funds. Now, they are diversified, just like a mutual fund, but they focus like a sector fund and they trade just like a stock. So we can buy and sell them during the course of a trading day, and most of them, or many of them, have options associated with them. And that is the case for all 11 of the select sector spiders. Together, they represent the entire S&P 500. Now, each sector can be bought individually, and that will give us exposure to that particular sector or industry group. Now, we all know that the institutional investors, and I'm talking about mutual funds, hedge funds, banks, insurance companies, they rotate in and out of sectors. At any one given point in time, certain ones are in favor with the institutional investors and others aren't. So by selecting the best performing at any given point in time, it kind of throws the odds in our favor for successful option selling. And that's precisely what I'm going to do in this video. So on the screenshot now, you see a list of the 11 sector spiders, and they include communication, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, technology, and utilities. And you could see the ticker symbols associated with each of those select sector spiders. Now, let me give you an overview of what I'm hoping to accomplish in this video presentation. As I said, we're going to start off with a portfolio exactly $100,000. Then we're going to locate the best performing select sector spiders over the past 1-month time frame. Those are the ones currently in favor with the institutional investors. Now, if we're going to select 4, that means we're going to allocate $25,000 per position. If we selected 3, it would be $33,000. But we're going to go with 4, be a little better diversification, and at $100,000, we can accomplish that pretty comfortably. Now, we're not going to spend the entire $100,000 on these ETFs because we're going to need a certain cash reserve in case any exit strategy opportunities arise during the contract month. So the guideline is, depending on the size of our portfolio, to set aside between 2 and 4% of our total portfolio net worth. In other words, we're not going to spend 2 to 4% and keep it as a reserve for potential exit strategy executions. Then we're going to go check the option chains to see if we can generate time value returns that match with our goal. And we're going to say for ETFs, our goal is going to be between 1 and 3% a month for our initial time value returns. Now, for ETFs, it'll be closer to 1 to 2%. But certain of these select sector spiders are a little more volatile, like energy and technology, for example, where we may be able to go up to 3%. But that will be our range in this particular video, which is reasonable, 1 to 3%. Now, the Monday after expiration Friday, we purchase the 4 best performing ETFs at that point in time, and we sell our covered calls. We're going to favor out of the money covered calls, which will allow us to generate not only option premium, but allow for some share appreciation from current market value up to that out of the money strike. Now keep in mind that ETFs, because they are baskets of stocks, tend to be less volatile than individual stocks. So our goals are going to be a little bit lower than those we would set if we were using individual stocks as opposed to exchange traded funds. Once we enter these trades, we're then going to set our 20% buy to close, good till cancel limit orders. In case the price of the securities go down, we will have a threshold where we buy back the call option in preparation for an exit strategy execution. And that information is detailed in my books and online video courses, the rationale behind these 20%, 10% guidelines. We manage our trades during the course, and you'll see that in this video. Some contract months, there'll be very few, some none, where there are no exit strategies required. But in most contract months, depending on the size of our portfolios, there will usually be some, and there will be in this video. And then we're going to calculate, after the post adjustments are made, our final 1-month results. Now we're starting the January 2022 contracts, that is in late December 2021, with the S&P trading at 46.21. This will give us a means of comparison because, as I told you, now this is looking back in hindsight, the beginning of the 2022 stock market year was not pretty. So by figuring out how we did for our contract and comparing it to the overall market, we can get an idea of how we did. So the S&P starts at 46.21. Now, how do we know which are the best performing ETFs? Well, for those of you who are premium members, just go to the member site, scroll down on the left side where you see this red arrow, and you'll see the last 5 ETF reports, only 4 are showing on this screenshot, and pick the most recent one. Now, again, you're seeing 413 is the most recent one when I'm making this video, but we're going to be looking at the January 2022 contracts where I saved the brokerage screenshots from my broker, and those are the ones we'll be sharing with you in this video. Now, the actual ETF reports are structured so that the top portion are all the ETFs that meet our screening criteria, and that information is shared in the books and online courses and so on. And then the middle section, which you see right here where that red arrow is, represent the best performing select sector spiders at that point in time. So that's where you're going to reference right down here in this middle section. Now, I actually created this graph for you from the select sector spider tracker, which shows on 12/19/2021, that was the start of the January 2022 1-month contract, the best performing select sector spiders. Now at the very top, you see I circled in the last month, the S&P 500 index was down 1.45%. Where you see the red arrows on the right side of the screenshot, those showed the 4 best performing select sector spiders. And those included XLP, consumer staples, which was up 3.62%, XLV, which was healthcare, up 3.13%, XLRE, real estate, up 3.24%, and finally XLU, utilities, which was up 4.07%. So when you compare that to the negative minus 1.45% of the S&P 500, you could see that these were the 4 select sector spiders that at that point in time were in favor with the institutional investors. So those are the ones we're going to use. We're going to use P, we're going to use V, we're going to use RE, and we're going to use U. And here they are listed for you. Okay, so those are the securities that we will select for our January 2022 portfolio. Now, how do we know how many shares to buy and how many contracts to sell? Here's how we do it. We're starting off with 100,000. So if we have 4 securities, we're going to allocate $25,000 per position. Now, this is approximate. Okay, we're never going to hit the nail on the head, or rarely anyway. So it's approximate. And remember, we have to have a cash reserve of $2,000 to $4,000 for possible exit strategy opportunities. So let's start off with our initial asset allocation, because this is going to change. So let's start off at the top with XLP. XLP at that time was trading at 75.21. Here's how we do it. We divide 75.21 into 25,000. That comes out to 332 shares. Now we could round up or down. So whichever we're closer to, we round down to 300 shares, which means we're going to sell 3 contracts. Now XLRE 50.05, that came out almost precisely to 500 shares, which means we'll buy 500 shares and sell 5 contracts. XLU trading at 70 means 357. That's kind of in the middle, but we'll round it up to 400, see what's what. 4 contracts. XLV trading at 137.93 comes to 181 shares. We'll round that up to 200. 2 contracts. Now, if we multiply the number of shares that we rounded up or down by the price per share on the final column to the right, you will see how much it will cost us. And then we add it up, and lo and behold, it adds up to $103,174. But wait a minute, we only have 100,000. And besides that, we need extra cash for potential exit strategy executions. So we have to reduce our holdings in one area. So what I decided to do here, instead of rounding up this 357 to 400, I decided to round it down to 300. So 100 shares left of a $70 stock, that tells me right off the bat, we're going to save $7,000. So that's going to wipe out this 3174 and actually leave us a cash reserve. So let's do that over again. And this time, we're going to go with XLU, not 400, but 300. And that gives us a cost of $96,174 to purchase these 4 select sector spiders. And that will give us a cash reserve of $3,826, which falls right into our $2,000 to $4,000 requirement. So we have our initial portfolio setup spreadsheet based on our system criteria. Now we go to an option chain. Now the weekend before the Monday of the new contract, the results will be a little muted because the market makers will kind of be a little careful about what they're showing in terms of the option chains. We want to make sure that we have an opportunity to establish a 1 to 3% goal. Now, what I did was I used the current price and an out of the money strike and the option chain values on the weekend before that Monday, which be a little bit lower than when it opens up that Monday. Once the early morning institutional computerized trading is over, we should get back a little bit higher returns. Also, the prices of these ETFs are going to change a little bit from the closing price on Friday. Usually not a lot, but it will change a little bit, which may also change our strike price selection. But by doing this exercise the weekend before Monday of the new contracts, we will have a framework that will save us a ton of time when actual trading starts. And you could see from the multiple tab of one of the BCI calculators that the return on our option is in the lower end of the 1 to 3% range, but it's in there. And the upside potential is also between 0.8 and 1.9%. So we're looking at about 2%, up to 3% maximum returns on these. This one here, XLRE, can be as high as 3%. But that does fit our framework. That's all we really want to know. Give us an idea of the price of the stock and which strike we're going to look at. We understand that could change. So yes, these 4 securities are applicable to our goal of a 1 to 3% 1 month initial time value return. We know our securities. We have a framework for the strikes we're going to use. We know that the time value returns are going to meet our goals. This work is done over the weekend before we actually structure our portfolio. Okay, here we go. Now these screenshots are taken directly from my broker, and you will see that I actually made a mistake and had to correct it. So on that Monday, I purchased these 4 securities. On the top, you see I purchased 300 shares of XLP, and it was filled at 74.18. I purchased 500 shares of XLRE at 48.83. Now, with XLU, remember I ended up rounding down and not up? Well, I made a mistake. I forgot to round down instead of up, and I bought 400 shares. Shame on me. So I immediately sold 100. No harm, no foul. So I have 300 shares of XLU, and then at 68.60, and I purchased 200 shares of XLV at 135.83. So now I own the shares. I am in a covered position, and I'm ready to sell my options. Here we go. So you could see here, I sold, I'll show you the first 2 and then the second 2. XLP, I sold 3 contracts of the 75.50 call for 77 cents. And then what's 20% of that? I put in my buy to close limit order, good till cancel, for 15 cents. That's 20% of 77. XLRE, I sold 5 contracts of the 50 call at 60 cents. What's 20% of 60? It's about 12 cents, but it didn't take it in, it had to go in 5-cent increments. So I put it in for 10 cents. XLU, I ended up selling 4 contracts of the 70 call, and I sold it for 89 cents. And then I put in a limit order for 18 cents. And XLV, I sold 2 contracts of the 137.50 call at $2.20. What's 20% of that? 44 cents. There you go. I bought the shares, I sold my covered calls, and I put in my buy to close, good till cancel limit orders. Now, good till canceled means that with these buy to close orders, they will stay there until we change it, right? So when you're doing purchasing of a stock or selling of the covered call, you want to do day only. But when you're putting your buy to close, good till cancel limit orders, there you want to leave it stay until you let the broker know, hey, I'm taking that down or I'm changing it from 20% to 10%. So let's summarize our trades on 12/20/2021 for the January 2022 monthly contracts. We purchased 300 shares of XLP at 74.19, 500 shares of XLRE at 48.83, 300 shares of XLU at 68.51, 200 shares of XLV at 135.83. Then we sold the options. 3 XLP, 75.50 calls for 77 cents. Put in our buy to close, good till cancel limit order at 15 cents. Sell to open the 50 calls for XLRE at 60 cents. Put in a buy to close at 10 cents because they only trade in 5-cent increments. Sell to open 3 XLU 70 calls at 89 cents. Put in our buy to close at 18 cents. And 2 XLV 137.50 calls for $2.20 and put in our buy to close limit order at 44 cents. Now, I make a note on my calendar that I keep in my desk when to change the 20% buy to close, good to cancel limit orders to 10%. And that's the weekend before the last 2 weeks of a monthly contract. So you'll see in the video, it doesn't take that long at all. And in this particular case, that would be on January 8th, 2022, is when I make the changes. Sometimes you won't have to because something already happened where you won't have to do it. But generally speaking, for those that are still in place by January 8th, you just change it to 10%. Okay, so let's take a look now at the actual activity that took place during the January contracts. So on January 7th, what happened? The buy to close limit threshold was reached on XLV at 44 cents. Remember, we put in a buy to close, good till cancel limit order at 44 cents. And because the price of XLV had declined, causing the value of that call to decline, that was automatically executed. Remember, it was a very volatile, bearish market at the beginning of the calendar year 2022. So this was hit on January 7th. And here's a screenshot. You could see that the order was filled, 2 contracts, XLV 137.50 at 44 cents. All right, so that's a screenshot that I saved from my brokerage account. Now, I also, and the next day, the 8th, what I did was I changed those 20% buy to close limit orders that were still remaining. So 3 out of the 4 were still remaining. I hadn't taken any action on the other one, but I changed them to 10%. So here's the example. XLP, we changed 15 cents. That was the buy to close limit order. We changed it to 8 cents. So half, 20% to 10%. 10 cents went to 5 cents. 18 cents went to 9 cents. And so now, instead of having 20% buy to close, good to cancel limit orders in place, since we only had 2 more weeks left until contract expiration, now we have a 10% guideline in place. And the reason for that is because the theta is eroding our time value of these options, there's less opportunity to generate additional time value profit in the last 2 weeks of a monthly contract, and therefore we're not willing to spend as much money to close the call as we were at the beginning of the contract. And that's the rationale behind the 20%, 10% buy to close limit orders. Now, on the 11th, I decided to act on those 2 XLV contracts that we had closed out the short call, and I decided to roll down from the 137.50 strike to the 136.50 strike, and that generated 80 cents. So remember, we bought to close at 44 and I sold to open at 80 cents. So we did generate some time value profit of about $72 that we added into our account. Now, on the 18th to the 19th, buy to close limit orders were executed on XLRE, 5 contracts at a nickel. You could see it on the very top here, and 3 contracts of XLU at 9 cents. You could see that at the very bottom of the screenshot. And I rolled down on the XLU from the 70 strike to the 69 strike, which you could see in the middle of the screenshot, the top red arrow, where I generated 38 cents. So on the XLU, I spent 9 cents and generated 38 cents. So I made about $29 per contract on 3 contracts. That was about $87, left maybe $2 of commission. So about $85 profit on that one. I never took any additional action on the XLRE. Now, on the 21st, what happened was 3 contracts of XLP were exercised at 75.50 because the strike expired in the money, and I didn't take any action to roll the option. So what happened was 300 shares was sold at 75.50, and that closed out my XLP position. So now let's take a deep breath and have a look at what the portfolio looked like after expiration of these January 2022 contracts. You could see on the top left, circled in red, was my final portfolio value as the January contracts expired, $99,615 and 14 cents. Well, that's a loss. It is, because we started with 100,000. So about $385 loss. That represented securities that I still own at 69,991, plus additional cash at 29,624. So that adds up to 99,615 and 14 cents. So, it was a small loss for the January contracts. So let's now look at that in comparison to the overall market, because we all know that when market conditions are bearish and volatile, that it's very hard to make money. But if we have beaten the market and beaten it significantly, then we have to say that we did our jobs as blue-collar investors and CEOs of our own money. So as the contracts expired, we sold XLP because the strike was in the money. Our portfolio value was down 0.38%. That was the loss that I took for the January 2022 contracts, with a portfolio valued at 99,615. Now, the S&P 500 closed at 43.98. That represented a 1-month return of minus 4.83%, which means that this particular covered call writing portfolio outperformed the S&P 500 by 4.45%. That was 1 month. Okay, so do we look at this contract month as a failure? I wouldn't. I would look at it as a huge success, because despite the huge market volatility and downturn, we still retained almost our entire portfolio value except for $385. Now, what do we do next? Well, ladies and gentlemen, the process starts all over again. What we do is we look to prepare for the February contracts, just like we did for the January contracts. When we have a structured system in place that we are confident in, and it doesn't have to be the same precise system that I present to you that I've been using for the last 2+ decades, you can tweak it a little bit depending on your trading style, your personal risk tolerance. But once you have that strategy and system in place, it makes it so easy to figure out what to do next. We locate elite performing underlyings. I showed you how to do it with the select sector spiders. In my material, you see how to do it with individual stocks. If you're going to use 4 positions, you allocate, in this particular case, 24,903 per position, because we have a little bit, about $100 less cash per position than we had for the January contracts, because we lost $385. Remember, we still need to set aside about $2,000 to $4,000 for potential exit strategy executions. And the process just starts all over again. So let's summarize this video. The factors that we need for successful option selling start with stock or ETF selection. And I gave you the rationale behind the select sector spiders. Option selection, expiration dates, initial time value return goal range, which we have to identify, out of the money, in the money, and then managing our positions. And it starts with entering our 20%, 10% guidelines, buy to close, good to cancel limit orders. Additional factors, including establishing that initial time value return goal range. This must be stated ahead of time. How are we going to know if a strike is appropriate if we don't know what we're looking to achieve? Once again, for ETFs, a reasonable range for 1 month returns. For our initial time value, initial 1 month returns is 1 to 3%, figuring most of the time it'll be closer to 1 to 2%. Allocating a similar amount of cash per position, this isn't rocket science, it's just common sense. And setting aside a cash reserve for potential exit strategy opportunities. Now, as you saw in this video, not all contract cycles will result in positive returns. We all know the market goes up and down. We know that when we seek to achieve higher than risk-free returns, that we are agreeing to undertake a certain amount of risk. And there will be certain periods of time when the market is challenging, it's volatile, it's bearish, and over the long run, we know markets go up. That's what they do. But for these particular time frames when they're going down, we have to know how to enter and manage our positions. And we will not beat the S&P 500 in every contract cycle, but in this one we did, and impressively so. Overall, we will beat the market on a consistent basis, and in many option cycles significantly, as we did here, if we master those 3 required skills: stock selection, option selection, and position management. And the reason is simple. When we sell options, we are lowering our cost basis. Once again, this is not rocket science. Now, for those of you who want to master these strategies, I'm just going to spend a minute on this. You can purchase our BCI package, an acronym for our best and most comprehensive educational product ever offered by the blue-collar investor. It has 18 components in it, 6 online courses, 6 calculators created by the blue-collar investor, 5 of our best-selling books, and our annual premium membership. Go to our website, www.thebluecollarinvestor.com. Click on the link that says BCI package, and we created a video that will explain all the perks of this package. You can also get our products individually by going to thebluecollarinvestor.com/store. You will have our online courses, our books, ebooks, soft cover, hardcover, calculators, spreadsheets, and our mentoring program as well. Ladies and gentlemen, we have over the years provided hundreds and hundreds of videos regarding the breakdown of individual trades. This particular video was something you've been asking for a complete portfolio from start to finish analysis. In this case, we used a $100,000 1-month covered call writing portfolio of the select sector spiders. I hope you found this video useful. I hope you enjoyed it. And most importantly, ladies and gentlemen, I hope it puts cash in your pockets. Please keep sending me ideas for new videos, for new webinars. We listen to you, and we thank you for supporting the Blue Collar Investor. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.